Hi, folks. So I think, a lot of us have been asking really similar questions, right? And I think a lot of us are at really similar points around, we've done all of this, we've created all these spreadsheets, we've been looking at these numbers, looking at these different tickers for these different companies. And, we're looking at some of these numbers in front of us, but oftentimes it can be very difficult to figure out, yes, we can track some of these different trends, right, in some of these metrics, but it is hard to get a holistic sense of how a company is doing, what it's actually worth, and whether you should actually, act on that stock or not, whether you should buy it or sell it or whatever else. And so there's a couple of different directions that you can go from right at this particular point. And one really popular direction that, I think a lot of people really prescribe to is this notion and this methodology proposed by, Ben Graham, Warren Buffett, around how you actually look at a particular company, right? So you create in your head, you come up with a valuation for a company, and given your valuation of that company, you decide to buy it if you think that the current price is actually undervalued relative to what you think the company's actually worth, and you would sell it if you think that the valuation, the price that is being paid for that company is actually more than what you actually think it's worth. But so even with that said, right, you're trying to come up with a valuation to help you figure out how you actually act. There's a lot of different ways, right, that you might actually come up with that valuation. And there's a lot of different formulas and methodologies that people have come up with over time to help figure out what that number should be. So today we're going to talk about one potential way that you can actually go through and value a company. And so this is something I've been digging into a little bit more recently over the past couple of weeks. I've mostly just been studying a lot of Professor Damodaran's material. So Professor Damodaran is basically a NYU professor of valuation and corporate finance. He has a wealth of materials online, both on his website and then also on his YouTube channel, about valuation and all the different factors that kind of go into that. And so this is where, I will caveat everything that I'm saying here that, I'm very much so still a student of all of this, but I figured that, I would try and encapsulate everything that I think I've been learning, put it into practice so we can kind of all start to study together and get better at this exercise. So, with that said, I'm going to, I think I'm actually going to try and break this down into a couple of key steps. So, this is going to be, I'm imagining a 3-part series. This first part that I'm going to talk through today is talking more so about a high level mental model of this valuation technique that we're going to talk about, how it's actually created, how it's actually constructed, the different variables that get powered into that. Because that's going to be, I think a chunk of material in and of itself. And then after we've covered that, we're going to then go into the actual valuation itself and go through the actual exercise of looking at a 10K, plugging in numbers into our valuation model and formula, and how we'll actually get a sample valuation. And then lastly, we'll probably take it back to the actual original company spreadsheet and actually talk about how to think about where this particular company falls relative to, in its overall corporate life cycle, and how you can use that as a framework with which to actually interpret all these numbers that we're seeing here. So the company we're going to be focusing on throughout this series is Shopify, as you can probably tell. But today we'll start out just first of all with the overall mental model, so that before we actually get into the valuation, you have a sense of what types of information we're trying to get out of the 10K and in order to actually power the valuation that comes out. So with that said, let's go ahead and get started. So I drew together a couple of just key slides just to sort of demonstrate a couple of key concepts that I want to talk about first, because I want to make sure we're kind of building up from a foundation, and that, as we talk about from one step to the other, we're not making too big of any logical jumps. So the first basic concept that I think we should talk about, because it's going to be fundamental to the valuation technique that we're talking about, is the notion of a cash flow. So all of us, I think, have probably heard of these similar terms, things like operating cash flow, free cash flow, but oftentimes, a lot of these terms start to sound very similar because they all have to do with money and expenses and stuff like that. And so I thought I would take a chance to kind of be super clear on what a cash flow is, why it's important, how it will actually factor into our eventual model. So at the starting from the very top, right, a company has revenues, right? So let's say this revenue is this whole big box right here. So the company's revenues, it's basically the sum of all the money that it gets in return for the goods and the services that it sells. So for a very mature company, right? Say a company like Disney, right? Where you have all kinds of different products and all kinds of different revenue streams. You probably have a lot of revenue because, you get revenue from operating like the Disney theme parks, and you get revenue from Disney Plus, and you get revenue from selling Disney merchandise. And so a really mature company is going to have a lot of revenue, but on the other hand, on the opposite end of the spectrum, let's say a startup, right, that's just started out will probably not have a lot of revenue because one, you probably don't have very many products, and if so, they're not very mature, and two, you probably don't have very many users because you literally just started. And so that though this idea of revenue though is the term and the bucket that we'll sort of start from, and we'll kind of basically be drawing out different subsets of expenses from that to eventually get our cash flow. So just talking about things at a high level, once again, you have all these different categories of expenses that need to come out of your revenue, right? So you've got your major top line expense of like cost of goods sold. So say that you are Apple, right? And you sell iPhones. It costs you money, right? Every single time you need to generate a new iPhone because you have to pay for the materials, you have to pay for the labor costs to put it together. And every additional iPhone you sell will cost you additional money. So all of that gets encapsulated in this first bucket of cost of goods sold. You then have this area of operating expenses. So things like research and development. So research and development, for example, if you are a tech company and you sell software, right? So maybe in that model, you don't have very many cost of goods sold because everything that you produce, it's not a physical good, it's just a digital good. So in that case, maybe you don't have a lot of cost of goods sold, but you will probably have a much higher degree of research and development costs because, instead of paying for, paying to create iPhones, now you're actually paying software engineers to actually, code up your program, code up your software that you then go and sell. So that's research and development. And then next you have this other category of sales and marketing, right? So you've got, for example, if you are a CPG company, so say that you sell like toothpaste or you sell like laundry detergent or something. Oftentimes, right, with these types of products, you need to do a lot of marketing and sales and marketing so people know what your brand is. They have that association. They'll go ahead and buy your product. So that can be a really big category of expenses. And then you've got things like general administrative. So, a company, right, you probably need an HR department, you need a legal department, and these are just general costs, right, that you have to make sure you pay for. And then after that, you've got different other categories of other expenses that you might have to pay. So say that you're borrowing a lot of money, you probably have to pay interest on the money that you're borrowing. If also say that you work in a really capital intensive industry. So say something like railroads, right? Where you have to build, you actually have to, own all of these different tracks, or maybe not tracks, but like probably the like rail cars and stuff like that. That's something you have to pay for as well. The general idea that I'm trying to get at is that you've got all these different categories of expenses and costs that you have to pay. At the very end, what remains is this idea of free cash flow. So it's basically all the surplus that remains from after you're able to subtract all the different costs from all the money that you're able to generate. So in this case, right, with this model, revenue is actually greater than all these different expenses, and so you have a positive free cash flow at the end. But at the same time, that's not always a given, right? Because say that you maybe are a really small company, so you have very little revenue and you have a lot of costs that you have to pay, you will likely have a negative cash flow. Or even if you do have really healthy revenue, if for some reason one of these different costs is very large, you will still have a negative cash flow that comes out at the end. And so the reason why we're harping so much about cash flow is because at the end of the day, this represents the amount of money that the owners of a company will actually get, right? So if you actually buy a piece of stock in a company, you are a partial owner, and that means that you have some claim to some degree of the free cash flow that remains at the end of the day for a company. So, with that said, that's a cash flow. This is going to be a really important concept as we talk about the next major step, right? So, the next major concept is the question of, what technique do we actually use to value a company? As we talked about, right? The value of a company, also known, I think, in some circles as the intrinsic valuation of a company. There's a lot of different ways you can calculate that. A lot of people have come up with different formulas over the years. And a really popular model that a lot of people use, especially in finance, is this idea of a discounted cash flow valuation model. So that's basically the model that Professor Damodaran uses. That's the one we're going to be doing today. But it can be a bit of a complex concept to understand, especially if you've never really thought about it in these terms. So I'm going to try and walk through it at a very high level, just so that we can kind of get a sense of what we're actually trying to do when we come up with this valuation. Just before we get into it, I will caveat this by saying this is a pretty complex concept, especially if you've never thought about it before. And so if you don't get it, maybe think, let it sort of let it sink into your head a little bit and just like let it percolate for a little bit. And over time, we'll be continuing to do more of these. So I think over time, hopefully it becomes a bit more clear. But we're just going to just roll with it, I guess, for today. And yeah, we'll see how it goes. So the general idea behind a discounted cash flow model is that the valuation is, so it boils back down to this essential premise that the value of a particular company is the sum of all the future cash flows that will come in the future for a given company, right? So as we talked about cash flow in, like, for example, in one particular moment, but if we actually look out into the future, right? So here's where we are today. And then say next year we'll have some cash flow. The year after that we'll have some cash flow. The idea behind a discounted cash flow is that we're going to try and figure out, one, what are all the cash flows that will come in the future for a given company, right? So what is the money I'll make in this first year out? What is the money cash flow I will make in my second year out? The cash flow I'll make in my third year out, et cetera, et cetera. And the other major premise of a discounted cash flow is after you've calculated this, right? So I have a sense of what I'm going to earn in cash flow for the next like 10 years, say in this model. The next major piece that we have to do is actually discount it, right? So that's the discounted part of the valuation. And the general premise behind this is that even though we're able to actually estimate out what the cash flow might be in year 1, year 2, year 3, because it happens sometime in the future, there is inherent risk that comes with that particular cash flow, right? And because of it, that's something you'll have to take into account when you're actually summing up what this will be worth, because there is a potential that you might not actually get the cash flow that you expected. To try and illustrate that and make it really concrete, let's say that you are Marriott, right? You're a hotel company, and say you're doing a DCF for Marriott in 2019, right? So this is all pre-COVID, everything is fine. You're trying to value Marriott and you're saying, well, okay, Marriott has grown its revenues and its cash flow at like X% a year. And so I'm just going to extrapolate that forward and say, next year, I think we're going to earn maybe like around the same growth and et cetera, right? And so yeah, you could come up with that estimation. However, of course, 2020 hits, COVID hits, travel essentially stops, and Marriott's revenues and cash flow at the end of the day, I haven't actually seen the numbers, but they have probably tanked, right? Because no one is traveling anywhere, no one is booking hotel rooms, and even though you probably estimated in 2019 that in 2020 I'm going to make, so like in this very dumb example, right? So let's say Marriott is making $100 in cash flow in 2019. You could try and estimate out, right, and come up with a expected future cash flow and say in 2020 I think we're going to make $150. Of course, COVID happens. You don't make $100. You don't even make $100, right? You maybe make like $50 with all the lack of travel that's actually happening. And so because, in the future, there's always things that might come up that will impact how much revenue, how much cash flow you're actually going to make. You need to factor that into the ultimate valuation that you're going to come up with, because there's a risk that valuation that you've estimated will not actually happen. And so the discount rate is basically how we try to approximate the risk that each of these cash flows comes with. And so when we actually go back to sum up, all these different cash flows in the future, we'll actually take that cash flow. So let's say in this case, 150, and we'll multiply it by the odds that we think we'll actually get that cash flow. So it would basically be 1 minus the discount rate, which is, the rate that we think that we won't actually get it. And so hopefully that makes sense. That is basically at a very high level what we're trying to do when we create a discounted cash flow. I'm going to walk through a really simple example just to make it concrete in very with discrete numbers. So let's say we'll use the same example, right? So let's say I'm currently making $100 in cash flow right now, and then I think this is what the cash flow will look like in all the future years since. So let's say that I think that, my discount rate should be 10%. So that basically means that, I think there is a 10% chance that this company will not make this cash flow. And flipped on the other direction, this also means that I think there is a 90% chance that this company will actually generate this cash flow. And so when we come up with the valuation of a company, as we mentioned, this is the sum of all the discounted cash flows. What that actually means as far as concrete numbers is that, okay, we'll take this year's cash flow. We of course know that because it has already happened, right? So $100, we'll start with that. And then we will start to sum for every subsequent year that happens after this year what the expected cash flow is, but we will also discount that by the chance that that company will actually make that degree of cash flow. So in this particular example, right, we start out with $100. We will then add it to 150, which is what we expect the cash flow to be next year, times the odds that we will actually make that cash flow. So in this case, it'll be 90%. Which leaves us with $135 because we remove the $15. We discount that $150 by $15 to take into account the fact that this might not happen. And so that's what it would look like for the first year out. And then one last item around one last item for the additional years after the first year. So another last concept that we'll need to throw in here just to complicate this just a little bit more is that we actually have to, when it comes to the year after the first year, we actually have to multiply it by the discount rate, or we have to take into account the discount rate multiple times. And to try and demonstrate that, so that can be a bit confusing because exponents are scary and all this stuff. But basically, the reason why you have to do this is because, actually, looking through the concrete example might make it a bit more clear. So say we're starting out with $100, right? We've already talked about next year, we think it'll be $135 because we're taking into account the 90% chance that the company will make that cash flow. And then when it comes to year 2, the reason why we actually have to multiply it by 90% twice is because we're already starting from, basically the idea of adding, multiplying it times the 90% multiple times is because you are already starting, the extra 90% is taking into account the fact that you're starting from a lower base, right? Because if you were to only do it, right, like say that you did the naive way and you said, okay, I'm going to add it times 150 times 90% plus 200 times 90%, that is assuming that you were able to actually make 150 last year, which we already said that it would be unrealistic to, right? It should actually be 135. And so what happens when you multiply it times this 90% multiple times is you take into account the fact that this number here is always much more optimistic, right? And so we always have to keep multiplying it back times, we have to keep making it a bit more realistic, and over time those compound, right? So in the first year it's 90%, but the year after that it's 90% because last year we had to discount it by 90%, plus we had to discount this year also by 90%. And so over time, that's basically how you try to keep that assumption going from year to year. So I don't know if that was super clear or not. We'll probably go over this again. But just to sort of reiterate and just sort of finish this out, this is basically saying, okay, so the second year we'll do 200 times 90% times 90%. The year after that, right? So year 3, we would do 250 times 90% times 90% times another 90%. because we're taking into account all the years of discounting that have happened in the past. So with that said, that is basically DCFs at a very, very high level. And now we're going to take it to our last basic concept, which is now that we understand the technique that we're going to use and what we're trying to do, we'll then think about, okay, if that is ultimately what we're trying to do, what are the actual sub-components and the different variables, right, that we'll have to plug into our formula to come up with a DCF valuation. And so this is in some ways just going to be reiterating a lot of what we've already talked about before, but trying to translate this into numbers that we actually will be calculating. We'll trying to retrieve from our financial statements, and two, actually calculating in the future. So if you think about it, there's multiple components that go into a DCF valuation, right? And so one major area is trying to estimate what do your current cash flows look like, right? So we get that from looking at all the past and current financial statements for a company. So that's taking into account everything that's happened in the past that has already happened. So you might get that information from your 10K, which is your annual statement. You might get it from your 10Q, which is your quarterly statement. But with that, you're basically trying to estimate out what are the cash flows that have already happened and what does that look like. And then the next major buckets of areas, as we've called out already, right, are looking forward into the future. There's two major things we need to know. There is one, what are the actual cash flows going to be in the future, right? And so you get that by taking into account a couple of key stats and a couple of key metrics. So we've got current revenue, which tell us where we're starting out from, right? So we get that from looking at the past statements, as we've talked about. We'll multiply that times what we think how revenue will grow in the future. So say it's $100 right now. If we think it's going to go to $150 next year, that means we think there's going to be a 50% revenue growth, right? So that will give us future revenue. But as we mentioned, right, revenue is only just one part of the story. We ultimately want free cash flow. So that's why we will actually multiply future revenue times our future margins. So future margins basically says what percentage of free cash flow, what percentage of revenue is my free cash flow, right? So what is the ratio that I get to keep after I take into account all of these expenses? And so when it comes to estimating future cash flows, there's two major metrics that we care about. One is revenue growth, because that tells us how big is this big pie here. And we want future margins, which tell us of that pie, right? How big of a slice do we get to keep? And then lastly, the last major piece, as we've talked about, is what is this discount rate, so, right? Which is what is the risk of actually achieving those cash flows? So we know how much we will discount these cash flows going back into the present. So with that said, I hope that makes sense. We are going to make this even more concrete by trying to break this down into the actual metrics that we'll be looking at when we actually go to start looking at a 10K. So this is basically reiterating everything that I said before. I tried labeling these also so it's consistent with what we've talked about here. But so these are just a couple of the slides that Professor Damodaran has used that I thought would be a good way of just trying to break this down. So to reiterate, I think for the most part, a lot of these things are basically the same, right? Cash flows, basically the same as what we talked about before. One additional item when it comes to this item, right, which is estimating growth, estimating what your future cash flows will look like, is that there's a couple of potential key drivers actually that you can use to help tinker with what the eventual cash flow will look like. And so just reiterating, we talked about the key metrics that we're looking at, but to make it more concrete, when it comes to future cash flows, right, there's a couple of different ways that you can improve them, right, going forward. So one potential, actually, so going back to this diagram, which maybe helps, is there's two different ways that you can drive cash flows in the future. One, you can increase the size of this overall pie, right? And you can say revenue is $100 now, but I think next year it's going to be $150. So I'm going to grow revenue by 50% to achieve that. And the other way that you can generate more cash flow is, where did I go? The other way you can generate free cash flow is more free cash flow is you can improve your margin. So in that model, you could say, okay, even if I make $100 next year, right? I don't get the 50% that I expected. If I improve my margin so that maybe so all my expenses I'm able to optimize my expenses. I'm able to pay less to generate the same revenue. I will actually be able to keep a larger percentage and be able to keep a bigger slice of the pie that I'm generating. And so to make that more concrete, just to talk through specific numbers, right? As we talked about, you can either focus on the revenue growth side, right? So say in the exact example that we talked about, you have $100 in revenue right now. If you have 50% growth, you'll now have $150 in revenue, which means that you'll have more cash flow. The other direction is to focus on efficiency growth. So that means that even if your revenue stays constant, if your margin improves, that means you get to keep a bigger slice of that pie. So say that you generate $100 in revenue. If you only have a 10% margin right now, that means you keep $10 of every $100 that you generate in revenue. But if you're able to miraculously, improve that to 20% margin, that means you get to keep $20 of every $100 that you generate, which means you get double the cash flow as you did before. And so those are two major key drivers of future cash flows that we'll be looking at, that we'll be estimating. And the last one that we'll also take into account is how long this growth period is, right? So one thing that we'll talk about a bit later is the corporate life cycle, right, of a company. As much as we all want as much as we all want infinite growth always forever, into the infinite future, that's really unrealistic. And for most companies, you have a very definitive growth period where you're able to really grow your revenue and all these other things. But oftentimes there is an end to it, right? Because for a lot of companies, it is hard to stay relevant and hard to keep growing for a long period of time. So that's another thing we'll have to consider as well. And then lastly, the other item that we mentioned is, right, the risk of achieving these cash flows and the risk that we'll actually be able to achieve that. And so that there's a couple of different places where that can arise, right? So it can come from the operating risk of a company and how the company runs its operations, where it gets its revenue from. It also includes the potential default risk of the company. So say like there's obviously different industries have different levels of risk. Like, for example, if you operate in the marijuana industry, right, which has previously been very heavily regulated, there is a much higher risk profile for that company relative to, say, like, a CPG company that has been around for ages and, where there's much less risk. And then lastly, the type of financing that you use for a company and the way you actually get money to actually run your company also can play a part. And we'll get into that into the next slide. So we have these major categories, right? Cash flows, growth, and risks. And this is a slide that will help us translate, okay, in each category, what are the questions that we are asking, right? And what are we trying to get a sense of? And lastly, what are the actual metrics that we'll be looking at in our 10Q or our 10K to actually try and estimate out what the value of all these different items will be. And so I'll just go over this at a very high level. We've kind of talked about a bunch of this already. So cash flows, some of the key metrics are really important. As we talked about, how much revenue you're actually making, that's really important. How much earnings you get, so that's the profit that you're making at the end of the day, that's really important. Current capital invested, we haven't talked as much about this, but this is important for reasons we'll get into later. But this is basically the general idea that, right, you have a certain amount of capital that you run your company with, and that can ultimately come from two sources, right? It can come from actually having more debt, so being able to borrow more money, or it comes from being able to sell off parts of your company to sell off equity to get cash. So we'll talk about that a little bit later, but that's also really important. And then next are other areas around growth, as we talked about, right? There's growth that you can get from two different ways. You can either get it from revenue growth, or you can get it from operating margins. So by improving your margins, you can get more cash flow as well. Another thing that we talk about here with this line item around quality of growth is the fact that growth, so growth, on one hand, right, you can look at a particular number, right? So say, like an example we've been talking about, you have 50% revenue growth, right? You're going from $100 to $150. The point that this line item is trying to drive at is that growth is not all created equal, right? So the way we can illustrate that is by saying, okay, growth, you can drive by doing a bunch of different things, right? So you can spend, for example, like say, okay, going back to like this example here. So growth, as we've mentioned, right, is not created equal. So one thing you can do to try and generate growth is you can spend a lot of money in sales and marketing, right? You can you can buy a billboard on Times Square, you can buy all the Facebook and Instagram ads in the world, and that will likely generate more growth, or it will generate more revenue growth, right? Because you're spending all this money, you're getting the word out, and all these people are learning about your product and they're using that product. But for example, if you spend, let's say, $90, in money to pay for all these ads, and you generate $100 of revenue, that is maybe not as great as, say, I'm able to maybe invest in something else. Maybe I'm able to invest in some smarter way of getting the word out there or something like that, and being able to generate the same amount of growth. And so basically we talk about, we want to, one thing we want to measure is, for example, in that case, the return on invested capital, right? So if it took us $90 to generate $100 in revenue, that is very different from us, say, spending $25 to generate $100 in revenue. And so that's something we'll also want to bake into our models so that we understand how that will progress, going forward into the future, because that is also important. And so lastly, our last major area is around risk, right? So as we talked about, there's different kinds of risks that can come up of being able to generate that future revenue. So operating risk is one we've talked about. So the business that you're in, right? So if you're in a much more controversial, much more high profile, much more, regulated probably firm, right? That will translate to a certain level of risk that you'll have to take into account. And also the countries that your firm operates in, right? So say that you maybe have a lot of overseas production. So say that you have like a factory in China that's creating all your goods that you're going to sell, or say that you get a lot of your revenues internationally. That will also impact how likely it is that you actually generate that revenue. Because, different countries have very different risk profiles, right? So if you're operating mostly in the US, that is a very different risk profile than if you're operating in China, or if you're operating in a third world country or in Africa or something like that. And so that's one thing you'll also want to bake into, your discount rate, because that will also play a factor. And then lastly, on the risk side, the last major bucket is around financial risk, right? So this is talking about the concept of, there's a very big difference when it comes to the capital that your firm uses to actually run itself. As we mentioned, right, you've got debt or equity, and debt and equity work very differently and have different levels of expectation. So with debt, right, as we're all familiar, right, with the idea of bonds, you buy a bond, and the way it works is that the general idea is that you will get your money back plus some degree of interest that the company has agreed to pay you. Versus with equity, it's very different, where instead you're giving a certain amount of money, right, to buy a share of stock. And with that share of stock, you're oftentimes not necessarily guaranteed any kind of income back, but you become an owner. And so that has very different implications for so depending on whether a company uses debt or equity to generate the cash that they need to run themselves, rewinding for a second. So because there's very different expectations for debt versus equity, depending on whether you use more equity or more debt will ultimately impact the financial risk that you will potentially have. General idea being that, say you have a very high debt ratio, right? So say that you are, over 50% of the money you're trying to operate on is debt. That means that you have a very big debt load, because that means that every single, however your repayment for your debt happens, every single quarter or year or whatever else, you are obligated to generate X amount of cash to repay back your debt holders, right? So repay back whether it's your principal or the interest payments themselves. And if you're a very small company, for example, and you don't have very much like steady cash flow, if you have a lot of debt, that is can be very dangerous for your company, because there's a very high likelihood potentially that you will not be able to generate the cash that you need to repay back these people. And so that's something else that you'll also want to factor into that the sort of risk profile when we're coming up with our discount rate. So with that said, that is most of it in a nutshell. The last major items that we'll also want to incorporate are more so like edge casey type things. So things that you also want to take into account in your valuation. So one thing that also potentially happens sometimes is companies own pieces of other companies, right? So that is something you'll have to take into account. Like, for example, say a company has a small share of another company, you'll want to add and include the valuation of that slice of that company into your valuation. Or alternatively, right, another thing that gets called out sometimes is if you own more than 50% of a company, you actually have to completely consolidate their finances into your finances. But it leads itself to some complications, because then you have stuff on your balance sheet and on your financial statements that you don't actually own. So you have to figure out how to subtract that out. Things like options outstanding. So this is another item that kind of gets factored in, because it ultimately impacts the equity that your company might have and how that will work. So yeah, all these things are things we'll get into later. But in a nutshell, I hope that explains and is a bit clear as far as what we're trying to do, how we're actually going to go ahead and create this valuation, and what are the key bits of metrics that we'll be tracking in order to come up with this valuation. So stay tuned for the next episode, where we will actually, we'll actually go through the actual worksheet and spreadsheet itself, go through an actual 10K, and go through the exercise of actually trying to pull this all together. So thanks.